Yes, so thank you for the introduction. And what we are going to talk about today, which won't come as a big surprise, is extinction bonds and addressing biodiversity issues through sustainable finance. So to start with, I'm going to go together with Martina through a couple of steps. We'll start with a brief introduction, the link between corporate governance and the rest of what we're going to do for the rest of the day, which I think is quite essential. Then we're going to talk a bit about the extinction crisis. Why have we decided to focus on this? Why have we written the book chapter on this topic? And then Martina will take over and talk about what the market situation is like, what the industry is doing in terms of sustainable debt, sustainable bonds, sustainable linked bonds, and like loans and bonds. And then we will together wrap it up with the extinction bond framework that we co-created for the book chapter. And again, like given that we are quite a small group, feel free to jump in, ask questions as we as we go along. I'm more than happy to answer anything that comes up. Now, why on earth are we talking about biodiversity and extinction bonds in a corporate governance special interest group? The reason is quite interesting, I find, is if we look at corporate governance, we have the traditional idea of the principal agents model, like if we go quite a bit back, and the conflict between the principal and the agent, and so on and so forth. And then we had for quite a long time something called an investment, the Wall Street rule, which is like you just vote with management, right? Like investment, like money votes with management. End of the story. So like for institutional money, there was not much of a conflict between investor and like investor as a principal and management as an agent, because institutional money votes with management. Now this has changed with the stewardship code. It has changed as an aftermath of the global financial crisis. This kind of institutional money votes with management and the change through the stewardship codes now mean that we are getting a different landscape of corporate governance. And one of these defining aspects that shape these corporate governance is active ownership. So if we have active ownership, we have the SDR2 in Europe. So we have now a compulsory vote on RENCOM. So remuneration and compensation have to be voted on at the AGM based on the SDR2. We have Climate 100 Plus, the initiative pushing on a vote for climate that basically would mirror the approach of the SDR2. This is in this current proxy season, one of the hot topics in the US. And let's see if it arrives in Europe. It's of course a little bit more difficult in continental Europe, a little bit easier in the UK. But we see here that investors start to play an active role in corporate governance, and that the Wall Street rule is slowly but steadily disappearing. And this is not only European or an American phenomenon. We see massive changes in Japan, which is catching up rapidly on these issues. We see Malaysia, Singapore, Hong Kong, a lot of the Asian markets, and the Australian market as well, catching up on these. In the case of Australian market, not necessarily catching up as it was some of the leading markets years ago. Now, what we see is that we have this not only with equity investors. So like the big role that we saw, the big shift with the stewardship code, were mainly focused on the equity investors. And only in the last iteration of the UK code, we included other asset classes. But it's mainly, the storyline is mainly active ownership through equity investment. But what we increasingly see is that also debt products are shaping corporate governance. And this is why we looked into this, like into sustainable debt products in relation to biodiversity risk. So I'm not going to spoil too much of this, but if we think about sustainability-linked loans, sustainability-linked bonds, where the lender determines specific KPIs that the business has to achieve in order to qualify for certain conditions, then this is a clear impact on the corporate governance of that company. And it's not coming from equity, and it's not coming through active ownership through equity, but it's coming from the lender. I mean, this is nothing new. If we look, for example, at the Japanese model and the Japanese model of a house bank between the 40s and 70s, 80s, we saw this influence on corporate governance by a house bank, by a lender, quite strongly playing out. So it's not necessarily new, but it's interesting to see how corporate governance is impacted by investors, may it be equity investors or debt investors. Now, on the extinction crisis, I will be short. We have an extinction crisis. I think everybody is aware of this by now. We have seen that over the last 40 years, we have lost natural ecosystems at the rate of 47% in the last 40 years. Global biomass of wild mammals, 82%. Global wildlife population, 60%. What we see, I mean, again, this is a massive risk. We are in the middle of the COVID pandemic. We see an increasing number of zoonoses, like viruses, jumping the species barrier, because we are getting more and more destructive, and we are infringing more and more into the ecosystems. So I mean, yeah. I want to be slightly provocative here and say that who hasn't understood the role of extinction and biodiversity yet in the middle, or yeah, unfortunately still in the middle of the COVID crisis, I guess will never understand it. So this is basically the backdrop of why we are looking at this. We are looking at this urgent crisis, the urgent extinction crisis, and we are looking into the debt products as the latest influence to change corporate governance. And Martina is now going to talk about what this actually looks like, what these products look like, and what the market reality looks like at the moment.
Thanks a lot, Chris. So yes, what I'm trying to highlight is a bit the different type of and the role of sustainable finance/debt instruments. So there's a broad variety out there. You see corporate debt instrument, municipality, sovereign debt. Ultimately, all of them play a relevant role as well in sustainable finance context. We are focusing today on the type of instruments that are very closely aligned with mainstream plain vanilla instruments on the one hand, so the ESG or sustainable bonds, that have fixed interest rate, that have increasingly different type of coupon rates also linked to floating rates, that have a defined maturity date, and ultimately that have a specific focus on the type of debt instruments you're seeing also in mainstream financial markets, but with an additional layer, which is the sustainability component. May that be at an entity and or at a project level. And I'm explaining this in a bit more detail in a second. So ultimately, the sustainable bond market has really taken off over the last 10 years, again, under sustainable bonds now, or the so-called use of proceeds, project-linked bonds. You see that they apply to a different range of environmental and or social projects. They're based on the green bond principles that were launched in 2013 into 14, that have now expanded to a range of different principles, social bond principles, most recently updated in the COVID context in 2020, and of course also a new range of guidelines for sustainability bonds. And I should add to this a broader now array of different guidance documents, also linked most recently to transition bonds. And I was delighted to be part of that working group and the report that came out in December 2020. So these type of bonds and the relevant ICMA green bond principles, ICMA, the International Capital Markets Organization, so association, I should say, now hosts the secretariat for the principles, and they actually are designed for industry use, for bond issuers, again, using mainstream bond instruments, especially here, bonds that have an interest in meeting sustainability criteria. And again, you know, initially when the first bonds were launched, they had a strong climate awareness focus. They were launched by multilaterals, they were launched by central banks, and ultimately, investment banks, European investment banks, so literally government players and multilaterals in that context. And then ultimately the situation slightly changed. In 2013, we saw the first issuances of corporate bonds, followed by municipality bonds in the green bond space. And then ultimately the type of bonds now, green bonds, social bonds, sustainability bonds, linked to sovereign issuers. We had more than 88 or 90 sovereign bonds that were issued over the course of the last few years, 2020 in particular, when and where also huge, large-scale sovereign projects were financed through the type of ESG or sustainable bonds that obviously are currently here in the spectrum. Moody's estimated the market is going, or has reached, you know, ultimately 490 billion and is expected to reach 650 billion in 2021. So that is, again, a year-on-year growth here, as you can see, of sometimes at least 30% plus year-on-year growth in that particular market segment. Then you have got, ultimately, beyond the sustainable bonds, two other subcategories. I will touch on them very briefly to explain this in more detail. Yes, please follow through with the next slide. This is a great slide to showcase the different type of bonds that I'm highlighting. So beyond the so-called project-based structures, the ones that we highlighted, sustainable bonds, you have also got target-based structures. And these are, again, two types of debt instruments, sustainability-linked loans and sustainability-linked bonds. Here in this context, we're comparing actually project-based versus target-based structures, so main on the bond side. But again, you could do the same type of assessment and comparison between green loans and sustainability-linked loans, just to highlight slightly the differences. So sustainability-linked loans have also got, in bonds, have also got their specific frameworks and principles. ICMA published principles for sustainability-linked bonds in June 2020, and they're offering, again, a guidance on how issuers should look at classification frameworks if and when and where they want to raise environmentally or socially friendly debt with financial terms. So, you know, they might have a variable coupon rate, but they are tied to an achievement of a specific ESG goal, target, or criteria. And that's ultimately what differentiates them from the traditional project-based structures that have more a framework around ESG criteria, not linked to the entity per se, but mainly to the project to be financed, but hence financing projects at scale, identifying the relevant sustainability categories and criteria has been sometimes a barrier to entry for some corporate issuers. And hence we are seeing, and this is also something we're touching on in this chapter, we are seeing really much bigger uptake across the corporate issuer spectrum particularly, but the same could apply if sovereigns would use such a type of vehicle, you know, that actually shifts the project discussion to a targets-based entity and or sovereign discussion if and where issuances apply. And last but not least, briefly on the sustainability-linked loans. I don't know if we have them covered on the next couple of slides. So sorry, there is a slide in between. But sustainability-linked loans, to capture this as well, they are any type of target-linked loan instrument that actually aim to incentivize the borrower to achieve also certain, we call them ambitious, predetermined sustainability performance objectives. And the interest rate of these sort of loan instruments is quite flexible, and obviously depends on the level of achievement of the predefined sustainability targets. So as you can see, both of them, therefore, sustainability-linked loans and bonds, classified as target-specific, target-linked structures. And they are seeing an increasing uptake in and across the entire financial services industry. So here again, the highlights of, again, the market momentum and growth achieved by sustainability-linked loans, again, to highlight they're an instrument that is only in existence now for 2 to 3 years. But again, particularly over the course of the last year, we have seen many new loan structures in this space coming to market, and we will probably see much more product innovation, which and when and where specific loan initiatives are being financed and supported in line with this particular vehicle. Maybe if we scroll back very quickly, and apologies, I didn't mean to take this up front, but it's maybe good to see these in context. I've also highlighted here very briefly the differences between the so-called green bond standard, which is now a prerequisite given the regulatory developments in line with the EU Sustainable Finance Action Plan, so-called the EU Green Bond Standard, EU GBS, and the ICMA green bond principles. So literally the green bond, social bond, or sustainability bond principles are voluntary guidelines for project-based finance, as we said. We also see that they are use of proceeds vehicles, as we had explained. They are literally linked to 4 core components. That's something we haven't touched on, but just to mention what it means to be a project-linked or proceeds-linked bond. It is actually the 4 core components of the ICMA green bond principles highlight that the bond needs to have the use of proceeds, the process for the project evaluation and selection, the management of the proceeds, and the reporting on the proceeds in line with the predefined sustainability framework. And interestingly, of course, the current ICMA Green Bond Principles framework is not yet fully aligned with the EU taxonomy. So that's why there is very often a debate, and this is why I'm highlighting it here very briefly, between the importance of ICMA's Green Bond Principles in the longer term context, given that we now have the EU GBS, which is the green bond standard at the EU level, which is ultimately a standard that incorporates the green bond principles, but now moves the trajectory needle towards alignment with the EU's taxonomy, alignment with more mandatory principles, especially when and where verifications, and ultimately other voluntary elements for impact reporting and metrics are concerned. And we slightly see there's also a shift when and where the components of the EU GBS are considered. Again, we focus much more now in the European context of the project and use of proceeds alignment with the EU taxonomy, in the moment the environmental taxonomy, but we are working here, as you know, the EU is working on a social taxonomy as we speak. And then we have a formalized green bond framework that needs to be met, and a more granular reporting, and we should say also a verification of these components when and where independent verifiers are concerned. So hence, I'm just highlighting this. This is another development in this space when and where we are moving from, voluntary to more mandatory types of vehicles, reporting in line with sustainability criteria that need to be met. And even when and where potentially now the discussion is moving from alignment with voluntary verification categories and criteria to ultimately voluntary developments in and when how impact reporting is concerned. And this is something that the Nordic investors have highlighted specifically, and where we know, and we have also highlighted this in our chapter, there are developments in our space that have looked at frameworks for impact reporting in the context of biodiversity. And again, ICMA was involved, and I was delighted to be part of some of these discussions. On the sustainability linked bonds, we have highlighted here again in a bit more detail the framework that is widely used in the industry. Again, sustainability-linked bonds are target-linked structures, moving away from what we just highlighted, which are the project-linked structures. Both of them, Green Bond Principles, ICMA, and EU GBS, both focus on projects. Now ICMA has shifted the needle, as I said earlier, towards entity assessments, and these sustainability-linked bonds, ICMA principles launched in June 2020, have actually now a slightly extended array of different type of components and features. So first of all, they have 5 core components. That means we look at a selection of key performance indicators, the so-called KPIs. They should be relevant, core, and material to the issuer's overall business. Again, the needle is shifting towards the entity and the issuer. And it should be, the KPIs should be measurable or quantifiable. They should be externally verifiable. Here again, we see the alignment with what the generic trend is, independent assurance and or verification. And they should be able to be benchmarked, in order to compare also similar issuances by similar or issuers within the same type of sectors or industry groups, potentially. Then the calibration of sustainability performance targets, the so-called SPTs, they should be ambitions. They should actually be based on a combination of the benchmarking approaches that are also, again, predefined and linked back to the KPIs that have been set. And there should be disclosures on target setting to make clear references in regards to timelines, etc. Then more specifically, the third core component are the bond characteristics, the so-called sustainability-linked bonds, and their financial structure characteristics can verify, and they depend obviously on the selected KPIs. Again, they could be rather focusing on an environmental, social, and or combination of the 2 targets or target areas. And ultimately, they also, of course, include at the core the coupon and coupon rates, and how they are being defined is very much in line with other financial issuances or structures and the relevant characteristics of mainstream corporate bonds. On the reporting side, again, issuers should publish and keep readily available, we say here, and easily accessible, a document that highlights the selected KPIs, that actually provides a verification and so-called assurance report, outlining the performance against the SPTs and the relevant and related impact criteria, the timings of these impacts, and the bond's financial and or structural characteristics. And ultimately, reporting should be published regularly and at least on an annual basis. And last but not least, that brings us, of course, to the element itself, verification. Again, as I highlighted, this is becoming a key feature, may that be on the project-based or on the target-based side of these type of vehicles. Independent verifications against, here in this case, the SPTs for each KPI by a qualified, they say, external reviewer with relevant expertise. That means by a second-party opinion provider or an assurance provider. And again, that verification statement should be provided at least once a year. That brings me, thank you very much, very quickly to the framework that we are highlighting here as well for sustainability-linked bonds. Very similar to what we have historically seen here as and when how the key stakeholders are concerned. So you have got ultimately the issuer works closely with the underwriter and the second party opinion or assurance provider for the verification statements. And you have got the investor at the other end. And the underwriter helps, especially in preparation of the financial statements and structures, of course, in the first instance. And they in turn also work closely with credit rating agencies and arrangers to help with the issuance and setting up the financial implications and structures of this particular vehicle. And the relationship, and this is why we highlighted this in blue, between the issuer, the underwriter, the investor, and then the second party opinion provider is key, because this is ultimately the add-on component which highlights when and where and how important the role of the second party opinion provider, but most importantly of the so-called opinion and review is in predetermining really the structure for the sustainability-linked bond, and in this case here, of course, for the entity assessment when and where sustainability criteria are concerned. And then ultimately, I'm handing now quickly back over to Chris.
Yes, thank you very much, Martina. So I'm basically now jumping in on the back of everything that Martina has already told us. So we, as I said, basically in the introduction, we then looked into this complexity of investors shaping ultimately the corporate governance of the companies through financial instruments. And we wanted to have a look at what would be a suitable way of addressing the extinction crisis through a financial instrument, like how to shape the company's corporate governance or to nudge it into the direction of taking the extinction crisis into consideration. And what we have done there is we looked into what Martina already explained, whether we would look into the project-based or the target-based approach. So we decided ultimately to look at the target-based approach, because with a project-based approach, whilst there are certainly advantages, one of the disadvantages is that you can have a very green project and you can get good funding for the very green project, whilst at the same time you can be an oil producer, right? So the question there is how much of an impact you're doing as a company, essentially. And with the target-based approaches, as Martina has explained, it's about KPIs of the company. It's not about KPIs of a project. So even if you were to have a great project, the question is, what KPIs are you reaching as a company overall? So that is what we focused on, and you see this in this overview, and I will go through this table, don't worry, in this rather massive overview table. This is why we look in this third column at the sustainability linked bond framework that Martina talked about, introduced by the ICMA. What we then looked into is the Extinction Accounting Framework, which was established by Jill Atkins and Warren Maroon in their two papers on exactly that, the Extinction Accounting Framework. So what we did then is we tried to bring together the academic literature on the Extinction Accounting Framework with the industry product design or industry framework, if you want, framework is the better phrasing than product design, but the industry framework on sustainability linked bonds, and develop out of the two an extinction bond framework. So that is basically what you're seeing in front of you. We have a 5-step extinction bond framework as an outcome of this matching exercise, of matching the Extinction Accounting Framework with the sustainability linked bonds. Now, the last column, this is, I guess you all know that it's when you have a brilliant idea at the beginning of your research and you end up with a complete mess in the end. That is slightly what we went through here, because we thought, okay, we are aware of, the new taxonomies and the materiality discussion, all of this. Why don't we link each step, each stage to one or two of the relevant frameworks and principles and guidance that are out there? The problem is that we ended up with an appendix. I don't know how long it is, but I think it's at least 5-6 pages, if not 10 pages. I don't know how long it ended up. But there are a lot of frameworks, principles, and guidance out there. Our initial idea around this was that you do not need to reinvent the wheel in order to set up or use this extinction bond framework. There is a lot of these frameworks out there, if you listen to Ian's presentation, and if you're doing research in this area, which I assume you do, otherwise you wouldn't be here, there are stark differences in the approaches used by these frameworks and the quality of these frameworks. if you have a quick look at what we have listed there, there are the different levels of focus: organizational level, investor level, industry level, and we have certification, international certification. It's a mix of everything, and we're not saying that those are even the only things that you can use. But the interesting point is that every single one of these framework has some ideas on that we considered useful, a useful match in this process where we basically assigned it. And the other thing is that a lot of the companies, if we look, like you will see that the ISO standards pop up at a lot of different stages. A lot of the companies are already using these things internally, like ISO standards, just being the obvious standard there. Right, but let me walk you through it and not kind of overload you with a massive table, which is, yeah, presenting 101. Don't present big tables in the beginning, but I assure you forgive me, and I will walk you through the different steps. So again, like the 5 steps that we end up with after bringing together the extinction accounting framework and the sustainability linked loan framework, bond framework, is these 5 steps. So first, to contextualize the extinction threat, then to conduct a materiality assessment of the extinction threat, then report and stakeholder dialogue on the extinction threat, then an impact assessment of your activities, and then refine and implement the project, which basically brings you back to step 1, understand the context of the extinction threat, identify what didn't go so well as the outcome of your impact assessment. So that is then the next iteration of step 1. Essentially, if we now look into step 1, like in the extinction accounting framework, it's called, you need to understand and assess the value in terms of biological and economic terms. So what are you looking at? What are the extinction threats that your company is facing? And then express these extinction threats in biological terms and express these extinction threats in economic terms. That is basically, in a very shortened form, what Jill and Warren write in their work. Now, in the match to the sustainability linked bond principles, we would end up with the sustainability performance targets, right? So, which means that we are already getting an idea of what are these what are the values in terms of biological and economic terms? Where do we need to ultimately set our corporate performance targets, and in order to avoid extinction in these in the habitats that we are active. Now, what frameworks can we use for that? On the biological one, we have the ICUN red list. This is the most famous list of endangered species, but it's by no means the only resource. So there we have the key biodiversity areas, we have Natura 2000 networks. There's a lot of information out there that already highlights the biological risks, the biological geographic areas, the biological species that are at risk. And not only do we have that, we also have complete technological standards how to capture this information. Not how to report it, but how to capture it, how to refer to different species, those are scientific standards, and we have them in the very long appendix. But I found that really useful, because again, we are not starting from scratch. You don't have to start from scratch to do this as a company. And then we have the economical side of things, where we would have, for example, the IFC performance standards that give us an idea of how to understand the economic impact or the economic value of the ecosystem. And again, there is quite a variety of others that play a role here. Now in step 2, we're doing the materiality assessment. Now the Extinction Accounting Framework would refer to it as risk and impact assessment of the corporate activities. In our sustainability linked bond framework, we have here our KPIs and our sustainable performance targets. So based on the materiality of the different issues, we define the KPIs. And then based on the context of step 1, together with the materiality, we identify basically where do we have to hit these KPIs. And those are the sustainability performance targets. So what are our targets to be achieved in those KPIs? I mean, we could have a whole conference around materiality, so I'm not going into too much detail, but there is, like, the devil is in the detail, right? Like we have the GRI, we have the new EU taxonomy with double materiality coming in. We have SASB that is rooted in the 1970s definition of the US Supreme Court. So we're seeing a lot of complexity there, but again, there is a lot of work done here already. We don't have to reinvent the wheel. Yes, there are a couple of others. The IFC operation principles for impact are also rather useful. And we will see what the Task Force for Nature-Related Financial Disclosure brings. Again, it hasn't been, we haven't seen the output yet, but there might be something in there close to the Task Force for Climate Financial Disclosure. So that is our second step. So first step, understanding the context. Second step, assessing the materiality of the corporate activities in relation to the ecosystem. Now then, reporting and dialogues are step 3. So basically in the Extinction Accounting Framework, Jill and Warren talk about action reporting, partnerships, and private sector efforts, which basically means the inclusion of stakeholders, of different stakeholders and different types of reporting and dialogue. We call, or not we, sorry, the Sustainable Linked Bonds Framework calls it just reporting. And Martina already mentioned what that would look like. It's basically reporting against the sustainable performance targets. And for that, again, we have reporting frameworks. We know, as mentioned before, that they have certain strengths, there are certain weaknesses, and they're useful for one thing or the other. But it would be a starting point for companies to start reporting on these as part of this step of the Extinction Bond Framework. The next step would then be to assess the impact. And in the Extinction Accounting Framework, it is analysis, reflection, and assessment of impact. In the Sustainable Linked Bonds Framework, it's verification. So it's what Martina already mentioned. It is the second party opinion provider, basically checking against the reporting, against the performance, against the sustainability, target, sustainability-based targets, and against then ultimately the KPIs, the key performance indicator, and finally the context, which it's all based off. We are back at basically based on. We are back at step 1. We have this verification, and for our frameworks and principles and guidance, it's basically an assessment of the impact on the extinction threat identified in the first step. And as I mentioned, it's an assessment against the KPIs and the SPTs. The ultimate target of this is, and this is where the emancipatory aspect of Jill's and Warren's framework comes in compared to some of the other concept is that we don't want to count fossils, right? Like we want to create a framework that enables positive impact and the preservation rather than the again the counting of fossils. So that then leads us to step 5. So once we have done the assessment, we need to see whether or not it was hit. That means in the case of the bond, whether or not you pay high or low coupon rate, right? So whether or not you hit your targets means you either pay a higher coupon rate if you don't hit the targets, or you pay a lower coupon rate if you do hit the targets. If you haven't hit the targets, then I would assume that you would rather like to refine and implement a new strategy to then hit the targets, because it's, you know, it's like, yeah, you signed up to, you end up paying a higher coupon rate that you wanted to pay. Now in the extinction accounting framework, again, it's called consolidated review identification of deficiencies. In the sustainable linked bond framework, it's the verification process. Now, what are the frameworks, principles, and guidance? Now, there are a lot of them there that we have already identified. The tricky bit is most of them are not built for iteration. This loop of improving and changing hardly ever happens. So in the frameworks, they're kind of linear. They start somewhere, they assess, they stop. So only a few of them actually have this iterative evaluation step where they say, actually, once you have done all of this, you can evaluate the effort or the impact that you have done through these and these steps. So in the chapter we have put a little bit more detail on those, but essentially, as mentioned, once we reach step 5, we reverse back to step 1 and go through the process again. Now I will hand over back to Martina for the conclusion, and we are almost perfect on time.
That's fantastic. Yes, thanks a lot, Chris. And I think really it dovetails nicely now together, you know, showing that there are obviously industry frameworks, principles-based frameworks and classification systems out here. The various type of biodiversity assessment frameworks, plus, of course, other reporting frameworks and taxonomies. And we have tried really to, you know, create a bridge between certain frameworks used by ICMA when and where sustainability-linked bonds are concerned. The same could and should apply when and where loan vehicles in this context are being constructed. But then ultimately we assess the various type of biodiversity criteria, taxonomies, frameworks out there that are actually applicable, and created this fantastic five-step sort of process around the analysis of a sustainability-linked bond in alignment with these frameworks. And again, what we've also seen, right, Chris, there's area for maybe improvement when and where harmonization of these type of frameworks are concerned. And we know there are many different efforts being made now in industry to build alignment around normative frameworks. We will see if and when how this sits together between reporting and accounting frameworks. And we are also seeing that now the regulatory landscape is becoming increasingly complex. The EU taxonomy should help, but again, we've seen, following on from their regulation, on the one hand for corporates to report on, and for the other end, investors to report on sustainability criteria and to actually highlight the way they use them in context. But there's maybe sometimes still fragmentation, especially around there is alignment with the EU Sustainable Finance Action Plan and the EU taxonomy, but given that there are currently only environmental criteria considered, there's also a disconnect between what is being collected, reported from the corporate end to what is then also being reported and highlighted at the investors' end, if and where alignment with regulatory frameworks is concerned on the one hand. And of course, you know, we have seen the different type of standards alongside the entities reporting information. Now, when we look at the project level of green bonds, there's also increasing confusion of what is a normative framework, what's its role, is it global, like ICMA Green Bond Principles versus European GBS, is it mandatory, is it only in the European jurisdictional context, and when and where does it actually have an impact on the entity's sustainability performance. And again, the only ones currently providing clarity or more clarity here when and where a KPI linked or a sustainability linked instrument is concerned is again a voluntary framework issued by ICMA. And to come back now to some of the concluding remarks here, what we have also highlighted in the book chapter is that the ecosystem and species extinction crisis requires, on the one hand, urgent and consolidated action from all market participants, and we should probably include here market and policy regulatory side. We have also highlighted that there's a clear market opportunity for sustainable finance debt instruments and a new generation of sustainability-linked extinctions or KPI-linked extinction bonds. I've explained again that they sit side by side with other vehicles on the project-based focus, that are project-based focus, apologies. And then you have ultimately now the increasing confusion, which I highlighted to begin with, around the different type of instruments with different type of frameworks and metrics. And that's obviously on both sides for the financial instruments themselves, when and where the green bonds frameworks are concerned, but also, and this is something again to highlight what we are highlighting in the book, when and where the different type of metrics for biodiversity are concerned. And again, Chris also mentioned it, we are looking towards the TNFD, and we hope that their approach, which is very much in alignment with the TCFD, to look at physical risks related to nature and transition trajectories related to nature risks, that these potentially could also now help defining a broader approach, how to look at and how to classify risks and opportunities in this context also for sustainability-linked bond assessments, for sustainable bond assessments, and the various type of frameworks concerned. And I think from here, we're very open to questions, just highlighting things, Chris. Chris and I are part of a network for sustainable financial markets, CIC initiative. We are an organization, a network for next gen sustainable finance professionals, academics, and thought leaders. We classify them in different groups, but very often we are all having different hats on and work across different buckets. And we hope actually with providing more insight and education capacity building initiatives and ultimately insights into certain areas that concern sustainable finance and ESG, we can really make a difference in educating the next generation of professionals or academics in our sphere. So please take the opportunity and visit nsfmnextgen.org, and we will be very happy to connect with you also via Twitter and LinkedIn.
Fantastic. But thanks to both Martina and to Chris. I mean, you did a great job, and you try to actually link between the emerging and upcoming developments, both in the regulatory front as well as the practices, both in the instruments and as well as the reporting practices. Fantastic. I mean, it's a wonderful presentation, and I think you did a marvelous job. You brought everything together. You know, it is it makes a lot. It's really, you know, I was trying to try to understand and try to reflect on some of it, but it's too many. Fantastic. I mean, you did a brilliant job. I mean, no, undoubtedly, it is wonderful, wonderful. So we have a couple of colleagues in the room. So let's see whether they have any questions. We have a couple of minutes actually left. So colleagues, do you have any question to either to Martina or to Chris? We can see a colleague from the beginning, Cork. Do you have any question to ask? And another colleague we can see, Yazid. So please feel free if you have any question to ask. Okay, so looks like they're not that shy to ask any questions. Okay, I mean, in my view, I mean, of course, the title is about extinction bond framework, I would say, I mean, we have covered a lot. It's like extinction itself. In that, I'm I'm not very familiar with this literature, but I am gradually moving into, because I'm a corporate governance person basically, but I am gradually moving into sustainable finance, trying to bring in more sustainability in governance. This is what I'm trying now at the moment. So my apology for my kind of question that might be very basic and maybe a layman question. Extinction accounting or extinction bond. I mean, this is the Zeal's, of course, significant development Zeal is making, and she has got a number of colleagues who are making progress on the specific field. I think, in my view, I mean, altogether, there are really a lot of things. So if I mean, in my view, of course, that might be very limited kind of concept, but extinction is something, it looks in, actually in my kind of knowledge is quite limited. But if you extend it to more about broader perspective, that is sustainability, that fits better in my view, because the coverage is huge actually. So that's a very basic question, but yeah, you don't need to answer. But I think there are a lot of things are really going on, because I had trips with Zeal a couple of times to South Africa once, and to several conferences Zeal is organizing on extinction accounting, and I try to grasp and learn. So it is actually phenomenal, actually. I mean, I should say, and you guys are doing very good. Especially Martina is, you are doing fantastic in the professional level. You are bringing together professionals in different levels, and I think I met a number of colleagues at the Stanbic conference in London, I think in 2019. Oh, that was fantastic. I mean, how brilliant is that to bring too many people? They have got interest in the area, broader area. And I'm also aware of Chris's research experience and also his expertise. So I mean, yeah. So I think you are making significant contributions in the field indeed, and uh, I mean, let us also do something together. I myself is a governance person, of course, try to bring governance alongside, and I'm still working on the boardroom still now, but try to see whether any environmental committee, any kind of committee level kind of development would be helpful. So yeah, so the discussion is going, I think, ahead, and it is something really very prominent. I'm sorry about the sound, because the guys are drilling, you know. Okay, so
Yeah, I think
I
if
mean,
you
thanks a lot from my side. It's a wonderful presentation, and I think I should appreciate and thank you both for your time and your expertise to share with us.
thank you very much. And if you're interested, like if the climate 100 plus initiative, that seems to be, to me, what will bridge the boardroom questions and the investors. I think that will be a rather interesting
I
development.
have Zeal knows that, because we are now in the way to set up an association on governance and sustainability. So we did a lot of paperwork already. So it is like in the process. Zeal and I both are involved in that, and so that is one thing. And alongside, I have got a number of PhD students. They have begin working on climate finance and governance actually together. So I think the
That
next
would
event,
fit right in there.
yeah. So the next governance event we are planning, the SIG event, possibly will organize with the conference as we are planning. So then you will be able to meet some academics who are like some PhD students, at least. They are working on governance and climate finance. So I think that would be a great opportunity, hopefully in the future. Yeah.
Sounds good.
Colleagues, do you have any question from anybody? Otherwise, we should conclude the session here. And I think they're shy. Okay. So thank you very much for the presentation, actually. And again, I should, I mean, what should I say? You did a fantastic job, and it is a wonderful. There are a couple of colleagues came in and out, actually. So don't be don't be frustrated. I listen to it actually with full mindset. Yeah. I try to take note of it, and of course, I believe some other colleagues also did. And thanks a lot. thanks for your time and patience and all the effort you made for the.
Thank you very much.
Thanks a lot.
See you very soon.